Good morning, everybody. Thanks very much for joining us. For those who haven't seen any of the sessions so far, you've just missed a fabulous one on senior housing and healthcare. We're going to be looking today here at impact, ESG, also some of the practical things around what investors should be thinking about. And we're going to start, so super speakers here as well. We're going to start with a fireside chat, just looking at one particular detail in terms of whole life carbon, but also recycling, sustainability, those sides. And I'm going to hand over first of all to Ron, and I will be back for the panel in a second. So if we could welcome Ron, that would be great. Welcome.
Yeah, thank you. Very happy to be here. I'm the managing editor of Real Asset Impact. And I'm also associate professor at the Amsterdam School of Real Estate. And I would like to invite Marco Göllrich on stage. Because Marco, you're one of the editorial board members of Real Asset Impact. And when we talk about, let's say, the asset class and ESG, it's also very important to talk about the circular economy. And I think that's still a big challenge when it's about the materializing topic. How do we measure whether it's carbon, whether it's wood, or the material is back on track because it's, I think, a very important topic. And you would like to elaborate a little bit on your hot dip galvanizing side. But I think it's also important that you underline why it's so important to have this discussion.
Thank you very much, Ron. I do that. It's my pleasure to do so. First of all, actually, Sebastian Engelskuchen wanted to be here, our managing director. He says sorry because he can't. And second, it's great to be partnering with you. Because I think, I don't know if it's a usual partnership to have like an industry association, really a producer of the goods that in the end up in your portfolios and in your real estate that you're investing in as a partner. And I think it's of great value, maybe for you as well, for us definitely. So thank you for this. The green one. Exactly. So very quick inputs from my side regarding batch hot dip galvanizing. Very energizing, long-lasting, and reusable material. For those of you who don't know what it is, and this is basic, I guess this is the larger part of this audience here. It's basically a corrosion protection method for steel. Think of it as the process. Think of it as a great grand wedding, where the fabricated steel is standing at the altar, strong and sturdy, but still a bit without its counterpart, still a bit vulnerable to the outside world. And this is where then zinc comes in, kind of the hero in this story. And zinc in a 450 degrees hot marriage or ceremony reunites with the steel and forms a protective layer that then in the end gives this durability for steel and protects it from corrosion for decades, sometimes over 100 years. Exactly. So next slide. So application examples are, of course, in construction and energy infrastructure, transportation as well. I think you can't take one or two steps in a city without seeing anything galvanized. Whenever you see a silver surface, a bit looking like camouflage surface, it's probably galvanized. And it is so important to have corrosion protection, because I don't know if you guys know, but the corrosion damage over years adds up to an economic loss of around 3 to 4% of GDP every year. It's a huge number. If you calculate it for Germany alone, we are talking over 100 billion euros in this case, and so it's very important to protect steel from corrosion. And you can do this by several systems. Several methods are obviously, there's paint as well. There are other methods, but for batch hot dip galvanizing, which is there and which is around for 150 years, it is really a material that is showing its proficiency in circular design and a low carbon footprint and durability. So the picture on the left-hand side you see is a terrace stand from a football stadium. Actually, I think it's in the Netherlands, Ron. And what they did here is they completely deconstructed the whole stand and sold it to a different stadium, basically. And then in the end, were able to put it together again at the different stadium, exactly. And what is interesting for you maybe as well is that this in the end saved them lots of cost. I think we're only talking 10 to 15% of the cost, but 100% of the functionality. Then the picture on the right hand side to showcase the durability of galvanized products is a small hut. It used to be a box office or ticket office in Bavaria, actually, for a railway, and it's over 100 years old, and there's still no rust showing at this little hut, exactly. And then also regarding the carbon footprint, I think what is very important for you guys as well is that we've recently did a study with a big institute in Germany, and were able to showcase that the carbon footprint of galvanizing is lower than of its counterparts, significantly lower, and especially in the circumstances where you look at the entire lifespan of a product. And I think this is very important. You highlighted it. We should look more at it, and I'm very keen to hear how investment world is at this moment in time looking at lifespan of investments as well, because this is obviously a big pro for durability. To showcase you again what is done already and is not some talk about the future or what can be done in the future maybe. This is an example from Switzerland where they designed the whole building according to a staircase that they saved from another building. So the floor height and everything was adjusted to the staircase they reused, and they made it their basically task to use as much reuse examples and products and components they were able. And only with the staircase they were able to save several tons of CO2. Now, what's in for you, of course, the long-term cost saving of using a material that is not only here for 10 years or 15 years, but that is here for really decades. It is really the sustainability alignment. You all have to deal with the taxonomy. You all have to deal with the European products regulations, the Corporate Sustainability Reporting Directive, and so on. And so it's very important what kind of materials you use. And when the products come to an end, or the lifespan of a product comes to an end, you see that the value of your investments will still be at a higher and more stable value if you use materials that are long-lasting and durable and sturdy, as steel with hot dip galvanized layer is. Exactly. So this was the very, very quick side. Not really a chat, more a monologue, but.
No, but I think it's great because it's also a little bit of an underestimated part of the built environment, and I think the material discussion will be much more important. And also I think in 2 weeks we will host the European Circular Week in Warsaw, and that's all about materializing. So I think it was very insightful and also a little bit of a kickstarter for the panel. So a big applause for Marco. And now up to you, Richard, for the panel discussion.
Great, thank you. So very interesting to pick that up, and if the speakers could join me, that would be great. Let's just start with some brief introductions, and then we can pick up on some of those topics. Let's start at this end. Let's start with you, Julie.
Sorry.
So very quick, 30 seconds on who you are and what you do, and then we'll work our way down. Julie, over to you.
My name is Julie Townsend. I am the Global Co-Chair of Sustainability for PGIM Real Estate. PGIM Real Estate is a big asset manager, third largest in the world at last count, so quite a big task in terms of integrating sustainability.
Great. Emily, over to you.
Hi, morning everyone. I'm Chief Sustainability Officer for Savills Investment Management, and we're a real estate investment manager with about 26 billion of assets under management.
Super. Robbie.
Morning, everyone. Robbie Epsom. I'm the EMEA Head of Sustainability at CBRE Investment Management. So similar to PGIM, we're a large real estate, real asset manager, around 150 billion AUM. What makes me really excited about that is it's like managing a virtual city. So lots of opportunity to drive sustainability. And I come from a background in sustainability advisory, chemical engineer by training. So really nice to get into the detail and help transition that city.
Great, Alex.
Yeah, fourth in line, repeat. I do the same job that these guys do. I do it for LaSalle Investment Management. And to flip it another way, I guess we've got about 300 buildings that we have to decarbonise and deliver sustainability. So that falls on me in Europe.
Great, thank you. Dirk.
My name is Dirk Paelinck. I'm a serial entrepreneur in Europe. We're specialized in conversion of religious assets. I have 2 technology companies, a co-working business, European PropTech Association, where I represent all the 3,200 startups in Europe in technology and construction real estate.
Great, thanks. So we've got quite an interesting mix here, different perspectives. And we're going to drill down. If there's any questions that you've got, feel free to ask them, and we'll try to deal with that. It's deliberately designed as a kind of smaller area so that then we can have interaction during the session. And thank you to everybody as well who's joining us on the live stream. We look forward to your questions as well. Let's maybe start. Let's start with you, Alex, just to begin with. I guess if we were here at EXPO Real last year and we're here this year, what's changed? What are you seeing that has, I suppose, changed in that 12 months?
Okay, well, I wasn't here last year, so...
there's one chart. There's one change.
I'm here. There you go. But maybe to frame the question a different way, and I'll let the others, maybe give their impressions on the event itself. But I think, a year on, certainly I've been in the role for nearly 3 years now, a year on from 12 months in what I do, certainly in Europe, and what we all do, I think it's just an sort of increased maturity of this subject and how it's being ingrained within the investment professional of real estate. And so almost like every day, every week, every month, it's sort of breaking new bounds within the organisation and with the industry about how do we, and this word gets used a lot, but how do we properly integrate sustainability and by that all the different components of sustainability into the decision making. And I think again, fast forward, I'm sure 12 months from now, it'll be a different journey again. But for me, that's been the journey certainly over the last few years of that maturity.
Okay, good. And maybe, Julie, one thing that would be interesting to pick up with you in terms of the global side. Are you seeing differences in terms of the regions, how they're addressing it, some of the trends?
Absolutely, there are differences, and differences in how far you can go in collecting that data and it informing decision making. But there are some very clear similarities in terms of within Europe. I would say it's probably the most ambitious. We are, as to Alex's point, it is embedded now into our investment process. The way that we buy, we're underwriting the risk, we're creating opportunity, we're positioning sustainability as part of our investment strategy and thinking about the exit and the value add within that. And the metrics are just more broad. There's more detail, it's more encompassing within E and goes deeper. But the US, which I think everyone's always interested to hear about because of the politicalization of ESG, it still absolutely matters because we have a fiduciary responsibility, and that is, different language in terms of, rather than say decarbonisation, I'm going to say energy efficiency, because every building, the more energy efficient, the reduced OPEX, and therefore, you're going to be able to drive up rent potentially. So it's just a different way of saying it, but it's actually ultimately the same piece. Physical climate risk really matters in the US, and we are seeing huge insurance premiums around risk areas. So again, it's a fiduciary responsibility. So we're managing that risk, perhaps not as advanced and as detailed in Europe, but it's there, and we're considering it, and it's integrated, as I say, across all of the parts of our investment decision making. We have asset level work plans, they're going into active ownership. It's all about the asset management, and it's absorbing that risk and making it an opportunity as we own.
And Robbie, feel free to pick that up as well. But it'd be interesting. I mean, I've noticed as well. Obviously, we've seen it coming through both in the stories, but also the strategies coming through in the Impact Journal as well. A kind of change over the year in terms of how people are talking about ESG, more to talking about sustainability or to reducing risk, or does it come down to the same thing in the end? But it's actually an easier way for the market to understand. What's your view on it?
Yeah, I think I'd echo what Julie's saying. I think when I was here last year, I said, we're past the why on sustainability in Europe. I think that trend is starting to spread more widely. And I think the way it works is you stop making it about the sort of legacy CSR type thing and you make it about the fundamentals of the asset. How do you actually improve it? Let's focus on energy efficiency. Let's focus on marginal gains in operational efficiency. And when you start having that language, you bring those that may have not been fully on board with the sustainability agenda, they get on board with it. And I think some of the key things, maybe adding to what Alex was saying on the trends, what we're seeing in Europe anyway, and I think this is also happening elsewhere, is people are no longer just waiting for regulation. They're getting on with things now, and I think that's really exciting to see. So topics like whole life carbon, biodiversity, we're not just waiting to be told what to do. We're starting to see people take some initiative, produce a bit of guidance. It might not be perfect, but at least we're seeing people taking steps forward.
Okay, good. And maybe let's pick up with you on that, Alex, as well. I mean, if we look at the E, we look at carbon reduction. If you are an investment manager, how do you actually go from the targets that we were talking about last year to actually managing that and delivering it on the ground?
Okay. That's what we all do, right? That's the job of what we're all doing. I think it's probably fairly obvious to say that the biggest challenge is the existing stock, right? 80-90% of the buildings that are here today are going to be here in 2050. So it's about how do we deal with the existing stock. New builds, major refurbs, obviously, that's sort of a given, and in a way that's being heavily driven by regulation and sort of building standards. But needless to say, that's also, dare I say it, the sort of easy win of where you can really attack sort of new innovation and things like that. So on the existing portfolio, really it's about getting down and deep into kind of what is the building, how is it made, how can we operate it in a different way. Our approach to that, certainly in Europe, has been we need to really understand the baseline. Now, you can use data, but we all know, and not to go off on a tangent, but data is patchy, and at the best of times is difficult to get, from an inaccurate sense. So we took the decision to go out and get auditors on every single one of our buildings. So we've now audited 220 buildings in Europe, and we've got detailed plans to say, okay, how do we go from today to 2030 and to 2050 with today's technologies, today's costs, and how do we get that aligned to, and we use the CREM methodology, which is the sort of renowned, known sort of methodology in Europe. And fundamentally then it's about, and what we're doing right now is then, and we've built a team to do this, is okay, there is cost associated with this, and this is my point earlier, we now need to go and work with the fund and asset teams and say, okay, how can we build these interventions into the business plans at today's market, yields and tolerances, and at what point is there, at what point, how far can we get effectively within that capital plan? And that's what we're doing right now. So it's effectively building this into the asset management plan, which is kind of what Julie said earlier. And that I would say is really where we, as an investment manager, are at when you talk about sustainability. Yes, it's focused on carbon, which I know is not the whole story, but it's probably the one that's obviously most focused from a regulatory perspective, most focused from an investor's perspective, and it's, dare I say it, quite tangible. And so that is the one where we are really, doubling down on trying to get this built into the business plans.
Okay, good. And I'm going to come to you in a second, Emily, on this as well. But Dirk, maybe just in terms of the technology, the innovation side, just tell us a little bit there about how that's going to be influencing, I suppose, positively this area in terms of sustainability.
Well, first of all, 6 committees of the advisory committees of the European Commission, so a lot of attention is going there to technology. And you can see it as huge funds that have been established to help technology. By the way, at the end of the day, at 5 o'clock, I have the EXPO Real Impact Awards, is about those technologies, celebrating them. But when you look at what we need globally in terms of technology investments to get to where we want, is about $8 trillion. And more specifically in Europe, we're going to need about $3 trillion just to renovate our buildings. There is something called renovation wave regulation in Europe, which is like really kicking in now. And it costs us in Europe about 400 billion per year on investments in new sustainable buildings. For the 3 trillion, we still know where we're going to get the money, to be very honest. But for the 400 billion in Europe, we are on track. We are even doing more than 400 billion of investments. And technology, of course, is a huge part of that, because if you don't have technology to lower your costs, to be more efficient, to go to net zero, when you look at what's happening now in terms of new technologies and raw materials that come out is just astonishing. We have also a session tomorrow with European Innovation Council. That's a part of the commission that funds groundbreaking technologies. They put in 30, 40, 50 million to develop something that will only come on the market in 4, 5, 6 years. And that's huge what we have there.
Okay, good. Emily, let's pick up with you just in terms of Savills Investment Management. So I guess, how are you integrating technology? How is that influencing what you're doing? I guess, what strategies have you got there?
I think from our perspective, technology is an enabler for where we need to go. It's not our driving force. So the key thing that we're doing is making sure we're using market-leading ESG data platforms to collect our data, get as much of that automated. But we've also been using GIS data as well to start to map our biodiversity impact. And so we've been working on our UK portfolio in particular, and we've been aligning our climate risk, our carbon risk and our biodiversity risk together so we can start to address all three, because we think nature-based solutions are going to play a key role in how they how we adapt to climate change.
Okay, good. And we've all been very polite and let everybody speak, but we're going to stop all of that now, and we're now going to. So, if you've got something to say about anything else anybody else,
could I? Yeah, just pick
Alex,
up. Just pick up on
you
that.
don't need to put your hand up. On
Okay, fine. All right, I'm just going to talk. No, just pick up on the technology point and the investment point, because I think those are big numbers, and sometimes it becomes a bit unwieldy as all these numbers get thrown around. Just to put it into practice, but like I say, we've done the audits across our European portfolio. I'd be curious to get thoughts from the others, but when you and you have to bear in mind that those assessments, the assessments that we're doing in the buildings today are today, right? So that's based on the technologies available today, that's based on the engineering knowledge based on today, that's based on the materials, notwithstanding the fact that there are new materials coming down the pipe all the time. And so the decisions that we have to make are based on today, but we're sort of effectively future-proofing what we have to do. But just on that, we can analyse and just from an illustrative perspective, one of our mixed funds, big mixed funds across Europe, multiple different asset types, so clearly this varies. But when we aggregate up and we look at, okay, where's the best value for our investment now, when you look at things like energy management and just the optimization of the way buildings are run, I mean, this is not sexy stuff, and this has been around for a long time. Yeah. But that, when you aggregate up all the interventions, that totals about 5% of the total capital that we've identified, and it generates about 25% of the savings in carbon. So there's still an awful lot that we can do that actually requires very little capital. And as I say, until some of these new materials and innovations, which is a whole other topic, but as we sort of engender innovation through the supply chain and those things come online, there's actually an awful lot that's available today, today's technologies, and can be built in at today's pricing. And so I just use that as an illustration of this is not necessarily having to go and reach and really kind of double down on capital. There's a lot available within that can be very much stomached by the service charge or by today's capital plans.
Okay, good.
I was going to say, I think the other thing around technology is that we can be using it to help us get more efficient in how we audit buildings. So we started off by doing net zero carbon audits of individual buildings, and we realised that the on-the-ground audits, we weren't getting very accurate information or as much as we wanted. So what we're now doing is building a digital twin model, and we're doing that at a fund level, which then means that we can then pinpoint to say, actually, these 3 buildings, we are going to go in the ground and go into a much more detailed audit, but these other ones, they're much, much lower in carbon emission, and we can do those later. So it's helping us prioritise. So I think technology can be really good from that perspective as well.
And are we also, does it play a role therefore in terms of, because there's been a lot of discussion around valuations, how can we begin to put the sustainability of buildings into the valuation model? So that kind of data, is that going to help support valuations in the future? What's our take on that?
Yeah, I think not just valuations, but also it'll help us sell sustainability, which sounds like a capitalist thing to say, but if we can't sell sustainability, then we can't raise the capital, whether it be debt or investment, to actually drive the changes. So what we're seeing, I think this is probably one of the big changes again since last year, is that things like EU taxonomy, SFDR, the KPIs, principal adverse impacts, things like the Energy Performance Building Directive, they're starting to give us KPIs which are effectively recognised by the market. And there's some great conversations going on between all of us to try and make sure that those are actually working, that we're all calculating them the same way, because if they are, then it starts to become something which we can build into our financial products. And the example I always give is if you wanted to launch a brown to green product, You know, you've got to have something which you use to define brown to green. You can't just say it's brown to green, and you know we'll just achieve something. You've got to show that you're going to do something tangible. EU taxonomy gives us that 30% reduction in primary energy demand, and that's great. So we have something, but we were all calculating it differently. And now we're starting to align on that. Starts to mean we can start to build this into a product. It can actually go in the contractual documentation. We can feel safe that the regulators recognise it, that our peers recognise it. So I think that's really exciting. But what's also exciting is that all of us are starting to do net zero as business as usual.
Yep.
Like we're actually talking about decarbonisation audits at scale, and we're all in that place where that is just normal, and we shouldn't take that for granted, because if we go back just a year, that concept was terrifying. People were thinking about systematic brown risk and values all being affected, and we've got through that, and now we're on to the more exciting things like biodiversity and social value. So some really good progress in my view.
Good. Dirk, you want
Yeah, I fully agree, because what's coming out in laws in Europe from the European Commission, it just doesn't stop. People think like we're there. No, I can tell you that for the EU taxonomy, right now, 60% of European companies have zero alignment with taxonomy. And we have only published 5% of the EU taxonomy. 5% is only published. It means that you're going to have a taxonomy for construction, a taxonomy for every department that you might have. So it's also something that is evolving. The EPBB is already a second version. We're going to do the third version. So it's evolving with the market, and it's helping, well, all of us in the industry who are working in sustainability at the highest levels to become even better. And that has a positive influence on the valuation of buildings. When you look at the latest report of the Joint Research Center of the European Commission, they've already published that top-rated green buildings have over all Europe together have a plus 22% in valuation. And the second thing is, there's a lot of labels in sustainability, a lot of confusion also. There was even confusion on the standards of the European Commission. That's why they published the ESRS regulation. But it's not gonna stop. We're gonna, for example, within the framework of the new European Bauhaus, which is now the central pillar of the European Green Deal. I have a session about it this afternoon. There will be what they call a NEB label, so new European Bauhaus label, and it will be the only one that will be valid for the European Commission. So they will not look at BREEAM and all that. NEB label, and that will be used to rate from their point of view, from the legislator point of view, to rate the sustainability of buildings.
go ahead.
I think this is one of our issues. It's a proliferation of all these different systems, labels, regulation, disclosures. About 4 years ago, when I joined Savills IM, we reported to 2 disclosure organisations, UNPRI and GRESB. This year, we're reporting to 14. And I think this is something that our industry needs to be able to tackle, and tackle it fast.
Yeah.
Because the amount of regulation that is coming our way with all different disclosure is actually in some ways stemming innovation, because our teams don't have the capacity to be able to deal with the regulation and be able to do the investor engagement and the capital raising and all the other things that we're needing to do. So I think it's something our industry really needs to look at, is how are we going to streamline this better?
Yeah, well, the only thing that is important for all of you, all of us, is that we get one rule. I mean, the legislator says that's it, like the ESRS. It's not completely clear, but it's more clear right now, so it's a very good thing. Sorry.
It's only a really small point, but just interesting. Last week on Monday was the first day of my calendar year where I wasn't working towards a disclosure, or my team wasn't working towards a disclosure. So we now have 4 months to deliver the change that we've just disclosed on. So that's how challenging it's got. And globally as well, it is just the proliferation of standards is extreme. The proliferation of metrics, the understanding behind these metrics. And that's where valuation sits so far off, because where does the value sit on if we can't all agree what the energy use intensity means when it's looked at 16 different ways on your nominator calculation across the globe, and that's without the denominator. It's so challenging out there to ensure that we're using the right benchmarks to understand that poorer performance, that risk, to create the opportunity, because that is where the business case currently lies. And I think it's when you have 229 billion of AUM, you have to prioritise, right? That's what PGIM Real Estate the challenge we face. We can't do net zero audits in every asset. We have to use tech. We have to use AI to understand that risk. But when we don't have the right benchmarks all the time, when the regulation is sitting on the wrong benchmark some of the time, it makes it incredibly challenging for us to get on with our jobs.
Yeah, and that's
it's
not only that.
I'm going to pause my launch of a new standard then.
Yeah.
Sorry, don't go on.
But it's not only that, very good point. It's also the data. Do we have the data to reporting on? Because in many cases you don't have them, or you don't have them in the right way or structured way. So it's also about using technology to, present those data, to collect them. And we see in a lot of buildings that it's even very difficult to collect the data. It's more in right now, in more than 70% of the cases, you can ask yourself, are the data 100% sure or not? And right now the Commission has a project running. It's a very interesting one. I think all of you should at some point join. We have established in Holland a tryout of a data space for real estate. And it's a small neighborhood, but we're collecting all the data that is relevant to that neighborhood in terms of energy use and so on. And what the Commission wants to do is to see if they can copy something else that they did last year in the mobility sector. They created a mobility data space. And right now, all the operators of trains, cars must store their data in that database, which is like for real estate, it's another game, of course, but it's just a way of thinking, right?
Just a couple of things. One is, fully share and the same pain, as it were, from a regulatory disclosure perspective. One of the things that we've done is to sort of almost split the team and have the team focused on half the team focused on tactical, technical, on the ground support at asset management level. Really focused on how do we convert these buildings, how do we change these buildings, how do we move these buildings forward, and then dedicate resources to, dare I say it, the kind of data challenge, the reporting just otherwise, if you club it all together, it becomes quite diluted, and dare I say it, you always end up prioritizing the sort of data reporting piece because that's a must-have. That the clients need it, the regulators need it. So that's just from a evolution, I guess, of what does sustainability look like, how do teams resource. That's something that we're still on the journey of, but starting to kind of shape. The other thing I guess I would just say is, yes, the standards keep raising, but if you just work to the standards, then when you talk about valuation, it's not that exciting. And fundamentally, real estate, certainly when you get down to individual building level and individual asset manager level, what they're interested in is being entrepreneurial about, how do I extract maximum value from this individual building? And that is a different conversation to, have you got an EUI of X, or have you got, the rating of Y? It's what does that tenant want, and what's the best thing that I can do to generate an additional value in that building? And that will be different for if it's an industrial building. Let's put solar PV on the roof. Let's give the tenant free electricity for the rest of the tenure of his lease, right? Brilliant. That's not going to be the solution if you're in a central, London office, for example. So I think we have to also cater for the window of opportunity of being creative and innovative at an individual building level. And whilst obviously there is this sort of top-down strategic regulatory kind of drive of how do we standardize everything, but actually there's an awful lot of individual kind of creativity, and individual buildings effectively are individuals. So we need to find that balance, I guess.
I think the challenge that we are in right now, because I totally hear you and I understand, I think our resources going to those disclosures, because where we're at in the property life cycle is we're all raising capital. We are all looking at the end investor, and we're trying to understand and make ourselves attractive. So it's EU taxonomy alignment, it's your disclosure for SFDR, is it looking at your PAIs and reducing your impact? That is where our time and energy is going, because that's where the business time and energy is going. And I think that's the challenge, is that those metrics right now are talking to us. That's what our investors are saying, so that's what's being embedded into our fund management and then down to the asset level. But you're absolutely right, it is what you need to do at the asset level through your active asset management to ensure that you get the exit value right and that you make the returns that you have set out to achieve. So it's a constant juggling act of how you prioritize sustainability within where you're in the life cycle, within the business need, because all of this has to have a returned revenue.
Yeah, but definitions really matter in our space. It's a highly regulated sector, and there's kind of two elements. One is the financial product. We need to be able to, like I said earlier, define what sustainability means at that level, but it's also the asset level. And I think there is progress where we are starting to collaborate and not just wait for the market or the regulators to tell us what to do. But if you can't define what a zero emission building is, which yes, we have in the Energy Performance Building Directive, then how do you persuade an asset manager to spend an extra, whatever it might be, 10, 20%, if you can't convince them that they're going to get to a point which is a goal? You know, this is now a highly efficient building. And if we don't all agree on what a highly efficient office asset in the Mediterranean climatic zone is, then how do we know if that building's got to where we want it to get to? How do we persuade our asset manager to spend more on it? If we have clear definitions, we can reach things which eventually the valuers will start to recognize and value will start to emerge from it. How much value is attributed to a highly efficient building? We don't know, but if you create that value point, you have something that you can actually work with. And I think one of the really important ones that comes back to, you know, the name of this session today is impact. Can someone please agree on a definition of impact? Because I genuinely believe that the will is there for people to launch impact funds, but there's nervousness about being called out for greenwashing. So we can create a safe, level playing field, at least across the European market, for impact, for sustainable, for transitioning. That really means, I think, that, you know, it'll take care of itself. The innovation will happen because people will feel, I can launch a new product and it's safe. Investors can invest in that product and also feel safe. So for me, over the next year, that's the change I really want to see happen, is let's define what impact means in transitioning and sustainable, and just start to agree to use it in a safe environment.
And let's pick up a little bit on the S. We've talked a bit about the E, the environmental side, but I guess, Emily, just pick up a bit in terms of what you're doing there in terms of that, whether it's Article 9 funds or Article 8 funds, or whether it's more of a focus on affordable housing or senior living or student housing or those kinds of things.
So we launched an affordable housing fund last year, and we're currently going through the UK process to get it to become a sustainability impact fund. And actually on definitions, the one thing I do quite like is the UK's SDR process. Yep. It's much easier to understand, and I think if the EU can keep looking towards what the UK has done, it's very rare, I would say that, but I think on this particular point, I think they've got it right, and it means that we've got much clearer definitions. There's still more that they could be doing to enforce that, but for example, with our affordable housing fund, the reason we're saying it's impact is because we're going to retrofit properties to bring them up to the right standards, so that we're buying existing properties and making them better, and then all new properties need to be, you know, at least an EPC A. And that's what we need in terms of getting this transition. We've got to retrofit older properties and we've got to focus on new ones, but we must make sure that occupiers are not the ones that don't get the benefits, and I think that's what we really want to focus on with this fund. So quite a lot of our metrics are around occupier well-being, tenant satisfaction, community development, as well as the environmental metrics as well.
Okay, good. If anybody else wants to pick up the social value one, do. I wanted to pick up a little bit on financing, because obviously that's a key element, particularly if you're looking at retrofitting, renovation, and those kinds of things. So I guess, Julie, let's pick up with you on that. So how are you seeing green financing? But also, I guess, because a lot of the larger funds also have debt funds within that, so they're investing both equity and debt into the area. So is that seen as the same strategy, or how do you see that?
Great question, and it's such
a big question.
Yes, quite a huge answer.
But in itself, but
I'll give you the perspective from PGIM Real Estate. We within equity we do core all the way through to value add. Within debt we do the whole capital stack, and you have to think about the opportunity that you're presented with within that. So I'll be honest and say the majority of our investment grade debt, our senior grade debt, that we're managing risk. So we are very aware of what our borrower is taking a loan against in terms of those key metrics, let's say the EPC in terms of regulation in Europe. But how far we can go at the moment is really in the high yield debt. And we will use our position right up front in that loan assessment to try and influence change. We haven't got to the point of saying that this is a green loan fund. We are looking at every single lend for the opportunity that it provides us. But we are looking within that to push out as far as we can around E and whether it's S as well. So yeah, we're trying to influence that change, and then we're bringing in KPIs to monitor during that loan. Would it create a default? I don't know, that remains to be seen, but it is something we're tracking and monitoring and managing. But there is a huge opportunity for debt within this. It's just, I would say, a little bit further behind equity. The data is one step away from you, so you can't always influence as easily. But yeah, we'll get to the position where we are looking at green lending. And I'm excited because actually our high yield debt fund in Europe is about to have its new product launched, and it will be Article 8, it will promote energy efficiency, it will have a level of EU taxonomy alignment. And I think that's a fantastic step towards where we're at in terms of the marketplace for lending.
Okay, good. I wanted to quickly, and if anybody's got a view on that, please do.
Just, just a practical example. So, very similar story. I think we're not there yet in terms of saying this is a green loan portfolio. Individual loans can potentially be, and we've done I think 5 or so this year on that are sort of green loan status. But what's interesting there is, and we're experimenting, and it is an experiment really, with like what incentives or penalties we can put in place as part of that. But this isn't road tested, right? Because the loan hasn't matured, and I think access to data and the journey that our borrower has to go on, which frankly, our borrower is probably another one of us, or it could be one of you guys, or so that's where again I think the sort of sharing of best practice and knowledge and standards and sort of definitions really helps, because we're fundamentally lending into the market and saying, this is a green loan, or this is what we want to achieve, and that language should be well understood by the marketplace that we're lending to, and there shouldn't be, which it currently suddenly is sort of rushing around trying to scroll around for, can we get this data, how do we prove this point? And so there's just too many man hours of trying to prove, is this thing doing what it said it would do? So again, I just sort of reinforce the point of, yes, and obviously the market dictates that lending, particularly at the moment, is attractive, but it reinforces the point of we need a common language of how we determine if it's good or not.
Just one more on that. I think the other thing is, in the last 12 months, we're starting to see a shift. So we previously have had Article 8 debt funds, so we converted existing ones, and we've launched a new pan-European whole loan fund, which is Article 8. But what we've seen is now we're being asked, can we convert a proportion of that to be aligned to impact? And I think that's an interesting shift, that we're moving away from just managing risk, and it opens up all the question about what is impact. And I think in this case it's impact with a little I rather than necessarily a big I, but at the same time it gives us an opportunity, going back to Alex's point, to experiment. And so we're quite excited as a team because we're now getting to start to put together an impact matrix for a debt fund, which we've never really done before. And so I think that's going to start to increase more and more, which I'm really excited about.
Okay, good. That's really interesting, that change there. And we will be able to track that at EXPO next year as well.
See what happens.
Robbie, I just wanted to pick up a little bit and get your perspective. Alex mentioned there a little bit about the importance of power, energy, sustainability, PVs, those kinds of things. How do you see that? Do you think we're moving more towards, assets disconnecting from the grid, about being self-sustainable? Are investors looking for more control over their assets? What's your sense of that?
I'm feeling really positive today. I think we have a different problem than we did even 2 years ago. So if I take the UK as an example, we are now absolutely ploughing ahead with decarbonising the grid. We're kind of harmonising everything. They launched NESO the other day that pulls together, gas, hydrogen, everything under kind of one roof. So we're actually hurtling towards having a fully decarbonised grid potentially by 2030. Our last ever coal power station was switched off, the license for the new one cancelled. So the conversation is almost now switching to, what does that economy look like, and what does that look like for the real estate world, the real asset world, when if we get this right and our grid is 100% renewable, all the power constraints are addressed, electricity is effectively free other than the maintenance and the transmission and distribution losses, and that's quite a different economy for real estate. What does that look like? Is it decentralized? Does it get built into service charge? Do governments start charging for that maintenance through a kind of council tax type thing? And in the UK we've got GB Energy. Could that be the role that GB Energy picks up? So we're in a very different conversation to where we were a couple of years ago of, what does real estate look like for that? Is there going to be help from governments? Are they going to go off in different directions? And we're seeing already the UK and Germany going off in slightly different directions, and how they're going to price and tax that maintenance, that transmission and distribution. And is that going to impact how we invest? And I think these are questions which we're now turning to, which is a really great place to be, rather than, are we going to decarbonise our grid? So we're back moving at pace. I think the conversation's evolving, which is exciting.
So in that sense that you've got, if you've got a comparable office building, let's say, in Munich, and you've got a comparable one in the UK somewhere, then actually because you've got a decarbonised grid in the UK potentially, and a not decarbonised grid in Germany, that actually might make a difference to your perception of value?
Well, it comes back to the comments on operational efficiency, doesn't it? So, when you start to get down to marginal gains, things like that do matter, particularly when they're at scale. So, I really do think, and I think we probably all reflect that when we look at our kind of house views on things like the grid are starting to feature in that conversation, and it changes what we do at the asset level. If you're in Eastern Europe and the grid's decarbonising more slowly, you might put your capex into on-site renewables. If you're in the UK, it's decarbonising faster, you might have a conversation around a virtual PPA or some kind of direct power sort of line. So the conversation is slightly different, and those factors driven by sustainability, but now fundamentals, are starting to play into it. So it's exciting, different place to where we were, and actually it puts us in the room as part of those core conversations on value.
I think also though we need to look at things like how we tax solar. So for example, it's much harder to put solar on your roofs in Germany than it may be in the Netherlands, and we're not going to get this economy of scale happening until we find ways to make that universal. And also energy prices as well. I think the energy prices for electricity are much higher than the energy prices for gas. So until we start to make that, on a level playing field, I think it's really positive, but I think there's still quite a lot of hurdles that we need to overcome in order to really accelerate this transition. And I think that's where the real estate sector needs to work much more closely with the government, and we need to get together and collaborate to push some of those topics and coalesce around some key asks.
Yeah.
Okay, good. I've got a couple of quick topics that I really wanted to touch on, despite the fact that it's getting towards lunch, and the idea is that there would be kind of 30 minutes, 25 minutes now, it'll be probably, to actually have a sandwich together, whatever, and chat in an informal way so that then anybody can also discuss these a bit more. But I wanted to talk a little bit about climate risk, how that's being addressed by people, because absolutely, Julie, what you were saying in terms of the US, you can see what's been happening, but also the insurance elements. So I wanted to pick up that a little bit, but also what are the new things that people need to be thinking about in this area? What will they be, so biodiversity, interesting, Robbie, that you mentioned that as a growing kind of topic now. So if anybody wants to pick up either of those, that will help me a lot.
I'm happy to say what I think are the key themes. I think I feel like we're, as the in-house team, starting to step back from things like net zero, because the teams know what they're doing. They know what to look at in investment committees and transactions. So that frees us up to start thinking, right, what next? And I think we already heard from Emily on the great work they're doing on biodiversity, and I'm seeing the same thing. We're preparing a biodiversity guide, so we're a bit behind where they are, but moving now on that topic, which is excellent. It does help when you get regulations like biodiversity net gain. It does help to push these things along. But social value, we can't wait any longer for the EU taxonomy to come up with definitions. I think we now need to come up with something and start working and making proper progress in a systematic way on social value. Whole life carbon is the other one, and I think it comes back to this whole thing on kind of renovation versus demolition, and whole life carbon is allowing us to have a much more meaningful conversation around that. So whole life carbon, embodied carbon, another really big topic. But I equally think this conversation across the sector about KPIs and definitions, and us being plugged into governments, the European Commission, that is also a really key thing which we all need to focus on in the year ahead.
The reason why the social part is a bit behind is that in the regulations about it, it's very difficult to find really good agreements between all the member states. Look at what's happening at the Commission in terms of the two most important things for now: energy and affordable housing. Most important. They even have a new commissioner now for it. It's one commissioner only for energy and affordable housing. So you need to have the agreement of everyone, so it's very difficult to establish more standards in that way. But the rules that will come out, they will come out only in about 2 years, will be very clear. It's like more like the ASRS standards.
I think I love Robbie's positivity, I do, and I'm behind it. But I think, and we've said it so many times, this challenge around metrics being translatable, definitions of standards. When we look at the US and the challenge of the US, and I'm going to say like 190 billion of the AUM that I manage and look after is in the US, right? So this is a massive piece to me. Biodiversity isn't really on their radar yet. And I even tried to say the word circular economy the other week, and it was like, whew, it's just not there. So, what we're going to do is we're going to look at it in Europe. We're going to use our smaller AUM to understand better metrics, but we can't take that size portfolio on that journey until we really are clearer, because otherwise, with all due respect, we could be taking that, we have a fiduciary responsibility, I've said that a number of times, spending money in the wrong place and not protecting the revenues that we need to provide back to our investors. So, I think Europe is in a great place, it's more ambitious, we're seeing more regulation, we have to be better at definitions and these metrics, because otherwise it's not translatable. We can't take it across the globe. And I want us to be able to. In the US, we're working really hard on energy efficiency, and we call it climate disasters. We don't do physical climate risk in the US, but climate disasters. And we'll be working really hard to better understand that, utilize the tool and understand our risk and opportunity. But they're not shifting off that in the near term, genuinely. And that's the reality of this. Biodiversity is a European issue at the moment.
Okay, good. And Alex, one thing that we haven't talked about yet, so just briefly, just because I was intrigued by it and hadn't heard about it, and I'm going to have to check it, which is antimicrobial resistance.
I knew you'd bring that up. Yeah, it's a strange one. So I guess it just sort of plays to the point of what's coming next. It's to explain the acronym, antimicrobial resistance is basically the speed at which I guess viral contaminations can transmit within spaces. Now you might think, oh my God, what's this got to do with sustainability? But it's something that we're starting to see from some of our clients come through. It's sort of a post-COVID reaction. And again, it's probably one which is sort of applied across all their investments. And it sort of hits real estate, and you sort of first glance, you think, oh, what's this got to do with real estate? But actually, it's got quite a lot with real estate, is that we spend 90% of our time inside buildings, right? And so it's probably more of a sort of health and safety type space, but it's one that is landing on, if you like, from a responsible investment criteria. It's one that our clients are sort of seeking a response to. And if you sort of play it through to tangible, tactical asset level, what does that mean? Well, it means, how are the spaces heated, cooled, ventilated, the filtration systems, the cleaning systems, and all of that. And it's an invisible thing, but as it becomes visible, it just becomes another metric that somebody and or an investor and or an occupier can judge the space. And then obviously you're into potentially attributing value to it. So it's just another marker down the line of the many, many other things that, as Robbie said, as we get over the line with net zero, it's like, phew, done, right, okay, there's now 50 more that we've got to tackle. That's just another one on the horizon that we've got to get our head around. So it's an interesting one.
Okay, and I can't move straight from antimicrobial resistance into lunch. I think I'm with the wrong thing. So a very quick question to everybody, which is, what do we want to have achieved by this time next year? Where shall I start? Has somebody got something that they would like to achieve?
I can start. So I think for us, where we want to be is that the industry is recognising more fully that you're not going to be able to adapt to climate change unless you put nature-based solutions at the heart of that. The EU taxonomy even says nature-based solutions should be the primary focus. And I think that I'd like the industry to understand more about how much the environment is dependent on real estate and vice versa. We use 30% of the world's natural resources for the built environment, which is huge. So I think we need to be a lot more cognizant of those interconnections. And I think over the next 12 months, hopefully we'll start to see that coming through in more kind of investor making decisions. And we're certainly finding the questions that we're getting from the Dutch and the UK investors are thinking about these topics, which is a good indication.
That wasn't a comment on that, by the way. That was
I think by this point next year, we're focused on obviously Europe because it's that's where these topics are starting to bite. We're preparing guidance for the business on how to navigate biodiversity, social value, whole life carbon. So we're effectively going on that same journey we did with net zero, integrating it into our business as usual, but to all the points that have been raised, making sure we do that in the right way, because these topics are interconnected. You know, biodiversity has social value links, social value has climate links, and they are connected. And making the wrong decisions, particularly when it's regulatory, things like BNG, biodiversity net gain, can actually lead you with, you know, big financial risks. So we've got to get it right, but also we've got to make sure we head off in the right direction, because it takes time to get these things integrated. These are leading to real world changes at the asset level, and we need to make sure they're heading in the right direction. So guidance integrated, so we're, you know, starting to get to where we are net zero on these other big topics.
Great. Anyone else?
I mean, sorry, you go, Jean.
Sorry, I would say, I mean, this is ambitious for a year, but do you know what? Because every single one of us has said it today, if we could just get some level of agreement around 10 of the basic E-metrics, then we start to really be able to think about value, assign value. Our jobs become so much easier, and then we translate it and we take it across the globe, because this is a global issue. This is not a European issue. But if we could all talk in the same language, you allow comparability, benchmarking, you assign a value, this becomes part of our business and our investment strategy.
Great, Alex.
Yeah, I mean, two really. One was where I hoped the market would be, and I think it picks up on both what Emily and Julie said, is just, can we bring some of these things together? Because actually, when you think in the whole, they all kind of interplay with each other. And as you say, you know, nature-based, social, you know, the E, they're all linked. And so I think if we as the industry and the regulators can do a better job of understanding how they're linked, and then we're all talking the same language, to Julie's point. But just from a LaSalle perspective, I think one of the things, and this is, you know, active challenge on me within the business, is we really need to articulate the value, and that value, and I mean that in a sort of with a capital V or a small v, it can be quantitative, it can be qualitative, but how do we communicate the value of an initiative, of an intervention, of an upgrade, of net zero decision to the business, and so that we can try and get more alignment around, okay, this is where we can, an asset manager or a fund manager or portfolio can get excited about, okay, I understand that, that there is real value attributed to this. So it's really unpicking what often happens inside the head of a portfolio or fund manager, and really trying to extract out of that, okay, but you made that decision because the tenant was going to be happier, or the tenant was going to renew, or you're going to be able to monetize that additional rent, whatever that is. Can we extract some of that and just use that to communicate internally, so we again just get better engagement, better adoption, and ultimately just the snowball starts rolling.
Great. Final word to you, Dirk, if you've got a name.
Well, I hope that in 1 year from now we have even more bright startups and scale-ups and technology inventors in Europe, and most of all that they work better together with the industry, because there's still a big gap between the industry and like property or construction technology companies, not talking always the same language. Lack of maturity, and on the other side, huge expertise, but also a lack of, from the side of corporates, I see often also a lack of enough dedicated people on innovation teams. It's of course not the case for big companies like yours, but it is the case for middle companies, and you should have someone focused on innovation, because ESG is not sustainability, and disclosure is not impact. Very simple. So if you want to have impact, you need to start sourcing and integrating technologies.
Great, thank you very much. We will now have lunch, which is great. There will be a chance also to meet Nicole here, who is the editor of Impact Journal. So if we're not writing about you, and you would like us to, speak to Nicole, that's the important thing. And do join us for lunch. If you've been watching online, thank you very much for watching. And indeed, if you're watching this on demand, thank you very much for watching. This is part of our live series of events here at EXPO Real. Thanks very much, everybody.
Thank you.